What does due diligence involve? Of all the stages of selling your business, due diligence is the one that makes sellers the most nervous. Someone is going to look through your books, ask a lot of questions about your contracts, your staff and your tax. It can feel like a bit of an interrogation, like they're looking for a reason to pull out. But here's the thing, due diligence isn't about catching you out, it's about the buyer doing exactly what's sensible for the person before spending a significant amount of money. In this video, I'm going to explain what due diligence actually involves, why it happens, and what you as a seller can do to make it easier, smooth, and straightforward as possible. Let's go back to what it's like to buy a house, because it works perfectly. When you buy a house, you instruct a surveyor, they visit the property, inspect the structure, check the roof, look at the plumbing, the wiring, access the neighbourhood. They're not assuming the house is falling down, they're just making sure that what you're paying for is generally what you're getting. Due diligence is the survey of the business sale. The buyer brings their accountant and his solicitor to look under the bonnet. They're checking that the numbers are what they're supposed to be, that the contracts are solid, and there's no outstanding disputes, and that nothing significant has been left out of the conversation. Just like the survey, due diligence might not turn up nothing at all, and that's the best outcome for everyone. Or it might flag something that needs addressing. Either way, both sides knowing about it are better off. Financial due diligence. This is the accountant's job. They go through all last year's books, the VAT returns, the accounts, the manager's accounts, the tax position, and the debtors book, and the cash flow. They're checking that the profit figures stack up and that the tax is paid and is up to date, and that the business is financially what it appears to be. This is almost always done first, because if the numbers don't work, neither does the rest. Legal due diligence. This is the job for the lawyers. They'll review any contracts, the employment contracts, client contracts, supply agreements, the property lease, and any ongoing or threatened legal disputes. They're checking that the business legal house is in order, the staff are properly employed, that the key contracts are transferable, and that there are no skeletons in the closet. Commercial due diligence. This is the buyer's own assessment of the business, the market it operates in, the strength of the customers, the key relationships, the risk and opportunities. An experienced buyer will form their own view on this through conversations they've had with you and the information you've shared. What actually happens in the data room? Once they head to terms to sign, the buyer's solicitor sends across information requests. This is a detailed list of questions and documents they need from the seller. Think of it as like a solicitor inquiries about the house. A long list of questions that need to be answered before the contracts can be exchanged. It can look daunting when you first see it, but most of it is straightforward. The documents and answers go into what's called a data room, a secured online folder both sides can access. This becomes an essential hub for the whole due diligence process. Typically, the documents requested will include 3 years filed accounts, VAT returns, managed accounts, corporate tax returns, and any HMRC correspondence, employment contracts for all the staff, key client contracts, suppliers agreements, any property leases, details of any ongoing disputes and claims, details of any finances, loans secured against the business. The more organised you are as a seller, the faster it goes. Buyers who are prompt complete the responses to the information request move through due diligence quickly. Delays almost always come from the seller's side, not because the seller has been obstructive, but because the information is scattered and takes time to put together. It helps to understand what the buyer is actually genuinely worried about, because then the questions make a lot more sense, and less of an interrogation. The biggest concern in any business sale is tax. If the business has underpaid VAT or PLY issues, or the director has been running personal expenses through the company, that becomes the buyer's problem the moment he takes ownership. So the tax position gets scrutinised very carefully. After the tax, the main areas of concern are staff. Are they properly employed? Are the contracts compliant? Are there any outstanding disputes or claims? Key contracts. Are the main client relationships properly documented? and can they be transferred to the new owner? Concentration risk. Does the business rely heavily on one or two clients? If so, what happens when they leave? Property. If there's a lease, does the landlord need to consent to change of ownership? Anything undisclosed, disputes, claims or liabilities that haven't been mentioned. None of these things are automatic deal killers, but they need to be understood, and in some cases they affect the price and payment terms. What due diligence can change? Here's something sellers don't always realise. Due diligence can bring change to the deal, but not necessarily in a bad way. If the due diligence process turns up something the buyer wasn't expecting, say a tax liability or a key contract that's about to expire, they have a few options. They might ask for the price reduction, they might ask for more of the price to be deferred rather than paid up front, or they might ask for a specific indemnity in the sale agreement, which means the seller agrees to cover the cost and any specific issues if this materialises. None of these are unusual. It's the same as the surveyor finding something on a house and the buyer's coming back to renegotiate. As part of the process, what it isn't none of that is unusual. It's the same as the surveyor finding something wrong with a house and they come back to renegotiate. As part of the process, what isn't a reason to panic or feel like the deal is falling apart. A buyer who raises the due diligence concerns is a buyer who's still engaged and wants to find out how to make the deal work. How to prepare as a seller. The single best thing you can do as a seller, get your paperwork in order before the process begins. That means making sure the last 3 years of accounts are filed and accurate, checking all the staff have up-to-date signed employment contracts, having copies of your key clients and suppliers' contracts ready and available, knowing the details of the property leases, when they expire, and what the terms are. Being aware of any outstanding disputes or potential claims, however minor, making sure that tax affairs are up to date, VAT, PAYE, and corporation tax. You don't need everything to be perfect. Most businesses that sell successfully have a few rough edges, and that's normal. What matters is that you know what they are and that we can talk about them openly. Transparency builds trust, and trust is what gets the deal done. The sellers who have worse experience of the due diligence are the ones who are disorganised and evasive. The ones who have the best experience are the ones who treat it like a professional process, answer the questions for these, and keep things moving. Due diligence isn't something to fear. It's a structured professional process that protects both sides. If a buyer who does it properly is a buyer you want to be dealing with. In the next video, I'll be covering what lawyers do. In the next video, I'm going to be covering what your lawyer does during the business sale, what they're actually working on, why it takes its time, and how to get the best out of them. If you're finding this series useful, subscribe so you don't miss any more of the rest of it. And if you'd like to talk through your own situation privately, get in touch. The link is down below.